Hi, good morning, everybody, and welcome to today's webinar on devising inheritance tax planning strategies. I think we're still waiting for a few people to join us, but I'm going to get started now since we're at past, and there's a few bits of housekeeping first anyway. So a little bit about me. My name's Vicky Elliott. I'm the Director of Private Client Taxes at PD Tax Consultants. A lot of you will have attended previous webinars we've run, mostly regarding business taxes, run by Paul Davison. So this is really the first kind of more private client-based webinar we're doing. Please do let us know if you have any other topics that you want us to cover. In terms of housekeeping, we've also got Amy helping behind the scenes today, and she'll be keeping an eye on the Q&A box. So if you do have any questions, either directly related to today's webinar or just on other tax topics, please pop them in the box. If we can, we'll deal with them at the end of the webinar, but if not, we'll get back to everybody individually if you have any more specific questions. So what we do, we provide tax advice primarily for business owners, high net worth individuals, but also charities, trusts, estates. And we work a lot with professional advisors. So that's a big part of what we do, is working as a team with other people involved in clients' cases. So if we just dive straight in, today's session is more based around the practical how to go about devising an IHT plan as opposed to the kind of intricacies of the tax legislation, mostly because that would probably be a full day, if not a week's worth of content, and we've only got about half an hour today. So there's 4 kind of main stages in the IHT planning process. So they are thinking about where are you now? So what's the starting position? And then going through to thinking about where do you want to get to? Well, or where's the client want to get to? And then once you know those, you kind of start and end point, you can start to think about how you're going to get there, what the plan actually is. And then once you put a plan in place, you've got to make sure that you monitor it, because tax rules change, people's circumstances change. So it's got to be monitored on an ongoing basis. So we're going to look at each of these stages in a little bit more detail. So if we start with the beginning, where are you now? So this is really an information gathering exercise. So it's got to be very comprehensive. You've got to find out everything from whether or not someone's got a will, what the family tree looks like, who are the family members involved, are there any non-family members who are important, friends, colleagues, employees, that kind of thing. What assets are there? What are those assets worth? At this stage, really, you're just looking at an estimate of the values. So you're not necessarily needing full valuation reports, but they need to be reasonably up to date. What is their current income level? That's quite important. And how much of that income is being spent? How much do they need to live off? What gifts have there been previously? And for some clients, you might also have to think about their domicile, if they've got overseas kind of aspects to consider, and possibly their residence and deemed domicile status. And then once you've got all of that information, you can pull together an initial inheritance tax calculation that gives you an approximation of what the IHT liability would be if they were to pass away immediately. From there, the next step is to think about where do you want to get to. So this is really thinking about who's going to inherit. So is it children, grandchildren, other family members, friends, colleagues? How are they going to inherit you? This often comes down to ages or degree of control. So is there going to be a trust involved? And if so, what type of trust? What is it that you're trying to protect using that trust? What are they going to inherit? So are there certain assets that are more suited to be inherited by particular people? So are there grandchildren that would be better off with cash that can help them up the housing ladder? Are there family members who work in a family business and it makes sense for those people to get the shares and other family members to get something else? And then when will they inherit? So is it purely going to be inheritance tax on death? Or is there some possibility of lifetime gifts? Every individual has a different kind of circumstance, a different set of feelings about this and what they're willing to do, what they're willing to give away, and what they want to keep control of. And also what they need to keep control of. If they need income, it might be they have to keep certain income producing assets to be able to sustain their lifestyle going forwards. So then once you know where you are, where you want to get to, you can start thinking about devising appropriate strategies for that particular client. There's various things. They won't all be suitable for every person, but generally it's a good idea to go through all of the different options just to see what may or may not be relevant. So starting off with some of the simpler aspects can be things like maximising allowances and exemptions. So looking at your regular gifts each year, using up your £3,000 gifts, looking at regular gifts out of surplus income. That can be a really useful IHT strategy, but the rules are quite specific and you have to make sure it's well documented, that the intention is documented, and that there's records of what the surplus income is, for example. And then the other thing is whether or not they're going to benefit from, for example, any unused spouse transfers of the nil rate band, and whether or not the estate is above or below the £2 million threshold for the residence nil rate band. And then there may be planning ideas that come out of those. It's also a good idea to check availability of reliefs. So the main ones here really are agricultural property relief and business property relief. But if there are any assets that you expect to qualify for those, it's always a good idea just to check that the conditions are in fact met. Sometimes you find that actually there might be a weakness in there. So we had a case not too long ago where there was a firm of builders for many years, but for one reason or another they'd acquired an investment company underneath the trading company, and so they kind of were concerned as to whether or not that was going to affect the trade versus investment kind of consideration for business property relief. As it was, the view when we looked at it in detail was that they were okay, but it was touch and go, and it would have been better if they'd taken advice earlier on. Another thing that often crops up with business property relief is often someone will have shares in a trading company, but they may also then have a director's loan, and the loan generally doesn't qualify for business property relief. But you might be able to convert that loan into shares in order to boost the BPR available. You need to look at whether or not, as said, whether there's any investments that could taint the trading status, and also think about what's going to happen in the future. So when we talked about where do you want to be, one aspect of that for a business owner is likely to be, what's the exit plan for that business? Are they planning to sell? Is it a family company and they want to pass the shares on, or are they planning to keep them? So if the shares are likely to be sold in the future, then you might have to plan for the fact that once that sale completes, they're going to have cash and they're not going to have the BPR any longer. And then probably the biggest planning area in inheritance tax is lifetime gifting. So here you've really got to be thinking what's going to be gifted, what type of assets, who's it going to go to, do they need to keep income? And if so, is there a way of gifting the asset whilst keeping some income from that? Typically that can be quite difficult to do, but there are ways in some cases where you can set an arrangement up so that for example, with properties, so that if they're still managing the properties, then they might be able to be remunerated for that activity. How to gift, so is it going to be a direct gift? Is it going to be a bare trust? That's often used for grandparents gifting to grandchildren, particularly for school fees. Or is it going to be a trust? And with all of these, you have to think about the interaction with other taxes. So if you're gifting away an asset, you may well have capital gains tax is the big one that you're going to have to think about. You have to think about other taxes as well. So if it's commercial property, you might have to think about VAT. Sometimes you'll have to think about stamp duty and stamp duty land tax. So you've got to make sure that you look at that big picture and think about which assets are being gifted, which can be gifted now without a tax charge. For example, if you can use CGT rollover relief, it might make more sense to gift those assets in lifetime and leave other assets in the estate. And then you've also got to think about, if you're going to do a mixture of gifts to trusts versus gifts to individuals, you need to think about the timing of those gifts, which ones come first. And there's a couple of different tax considerations there, which I won't go into now, but it is just something to make sure that is taken into account in this strategy. And then finally, there's other general common planning opportunities available. So pensions are generally very IHT efficient. So it may well be worth speaking to a financial advisor to see if there's potential to put more money into a pension. That will depend on the age and the existing pension provision that's there. There's a lot of talk generally at the minute around incorporation of rental businesses and family investment companies. Now, they're not directly IHT strategies on their own because they still own the assets, it's in a company wrapper. But it does make it sometimes easier to combine with, say, a lifetime gift, because you gift away the shares directly or into a trust, and you can use the share rights to restrict what you're giving away and the level of control that you keep hold of. You can also look at things like recycling business property relief. So this might be a case, for example, if you have someone with both a BPRable asset and cash, and on the first death, you leave the BPRable asset to the children, the cash to the spouse, and then the children, typically who've received the BPRable asset, sell it to the surviving spouse in exchange for the cash. And then on the second spouse's death, you get the BPR again. Obviously, there's a lot more to consider with that example, but that's just one of the types of things that can be thought about. Typically, IHT planning is always best looked at before death, but there can be cases where post-death there's still planning to be done, and that would often involve a deed of variation. In some cases, it can be worth looking at the charitable gift and the 36% rate of inheritance tax. It's not, again, on its own an inheritance tax saving strategy, because overall the money that you have to gift away to charity means that you don't actually end up better off. But if you've also already got a substantial gift to charity, just increasing it slightly, you could get a tax saving. Or if the recipients of the inheritance are likely to be doing lots of gifting anyway in their lifetimes, then it could make sense to do it through the estate. And then once you've got the your plan, you've got an idea of what you want to do, what the client is willing to do, what's suitable for them. You've got to think about what obstacles there might be. So I've already mentioned that you have to think about the other tax costs, but you've also got to think about whether there's any anti-avoidance rules that could affect what you are wanting to do. The most common ones that you're going to come across are assessments legislation, gifts with reservation of benefit, and pre-owned asset tax. But it's also worth keeping an eye on more general issues, the general anti-abuse rule, and also the DOTAS rules as to whether or not what you're doing needs to be disclosed to HMRC in advance. And then the other thing is to make sure that you're working with others. So typically in inheritance tax planning, you look at involving quite a few different people. A recent case I was involved in had myself, 2 accountants, because the client had different accountants for different businesses. Each of those accountants was doing different valuations for the shares. There was 2 financial advisors, one for pension, one for other investments, and then 2 solicitors, a corporate solicitor and a private client solicitor. So there was quite a team of us who had to work together on it to get everything done. And it's really important because everybody's got different bits in their toolkits, and some of the planning things that I might look at are going to be different to those of a financial advisor or a solicitor. And you've got to make sure that you get other people's input where needed. And then finally, it's on to maintenance. So regular reviews of the inheritance tax computation and will. So this is after you've come up with a strategy, you've checked the obstacles, you've put everything in place that you're going to put in place. It's all been implemented. You need to make sure that you keep an eye on it in the future. So this isn't a once and done job typically. You've got to keep an eye on it because asset values are going to change. There may well be changes in the tax rules. I think there's a lot of kind of talk at the minute of possible tax rises in the future because of all of the government support for COVID-19. And there's right now there's no way of knowing where those tax rises are going to come from, but it's possible it could change some of the inheritance tax rules that we're thinking about. The 7-year clock on lifetime gifts. Obviously, old gifts might fall out of account. They might make new gifts which need to be borne into account going forwards. And there could also be changes in the objectives. For example, if the family circumstances change, if there's a falling out within the family or an estrangement, or if the financial needs change. So if income needs change, or if income levels themselves drop or increase for some reason. So really, I'd say ideally once a year you'd look at all this, but it could be every couple of years. It depends on the client really, but it just needs a regular touch point afterwards, so it doesn't just get to a case where you're thinking, oh, we've done the inheritance tax planning, and it turns out that was 10 years ago, and things have changed quite a bit since then. So that's all of the content for today, really. But first of all, before we come on to questions, if you have any topics you want us to cover in future webinars, please send me an email. We are currently working on kind of the webinar topics for 2021. So if you have any suggestions, any burning questions that you want covered, please do send us an email. And then we'll move on to questions. And hopefully Amy will have some questions that have been submitted.
Yeah, I've got a few. Is there a typical client that you found can benefit most from IHT advice?
Really, anybody whose assets are over the kind of nil rate band, residential nil rate band, may get some benefit from thinking about inheritance tax. The bigger the estate, the bigger the opportunities generally. And yeah, that's it really.
Can you talk us through an example of some planning that you've carried out recently? How much tax was able to be saved?
Yeah. So the example I mentioned earlier with all the different people that were involved, that particular client, it was a husband and wife who owned various companies through shares, family companies. They also had some investment assets, some commercial premises owned personally, and some cash in savings and ISAs, for example. They had enough income that they needed from their pensions. They didn't need any more income. In fact, they don't spend the income that they receive. So they're constantly adding to their capital. They don't take money out of the companies. They haven't declared dividends for a while because they don't need to. Some of the shares in the companies were also owned by family members already. So for that case, we did a range of things. So they had some quite substantial directors' loan accounts. So we converted those into shares because it was better for business property relief. And they had no intention of drawing down on the loans and no need to draw down on them either. So we did that planning in terms of the business property relief. We did some planning in terms of the shares in the investment company. So one issue that sometimes crops up is that couples might want to keep shares in an investment company, and then after the first death, the spouse might then decide to gift away some of the shares, and they're trying to take advantage of the fact there's been an uplift in value in the base cost of those shares. But what can happen is all the shares get pulled together. And so actually you still end up with a capital gain when you go to transfer the shares. But what you can do is if you make them so they're different share classes, you have A and B shares, then they're pulled separately. So you can still make use of that uplift in value without having a CGT issue. So we put that in place ready. We also looked at a lifetime gift to a trust for the grandchildren. So in this case, they decided that they wanted to gift the ISA investments, so they were kind of disinvested by the financial advisor and then reinvested in a trust wrapper for the grandchildren. And then we also do just about to go ahead with some direct gifts to the children of shares. And that's to get them below the £2 million threshold for the residence nil rate band. Now, the combination of all of that planning, initially the IHT liability was estimated about £770,000. If with all the planning in place, asset values as they currently are, the projection is in 7 years' time, the IHT bill will come down by about £725,000 to about £44,000. And of that, around half of that saving is actually an immediate saving through the residence nil rate band and the BPR planning that we've done. The rest will take 7 years to take effect because it's related to the gifts coming out of the estate. So that was a really good example. There was lots of things that they could do, and they had, because they didn't have need of the assets or the cash, there was a lot of opportunity for planning for them.
Thank you. How do you go about converting a director's loan into shares?
Yes, there's two ways you can do it. You can do it through a simple share subscription. If you do that, you have to bear in mind that it takes 2 years for the BPR to take effect because of the normal rules. But you can also do it through a rights issue, and that takes effect immediately. That's quite a well-known path. There was a case a couple of years ago, probably more than a couple of years ago now actually, on this, where I think the taxpayer converted some loans using a rights issue, and the HMRC and the tribunal accepted that was fine. But then there was some other directors' loans that for one reason or another weren't converted into shares via a rights issue. And on those shares, there was inheritance tax to pay because she died before 2 years elapsed.
Have you got time for one more, do you think?
Yeah, let's go for it.
Is it possible to alter a will after death to avoid inheritance tax?
You can use a deed of variation to alter a will. Whether it saves inheritance tax really depends on what it is that's being done. So I suppose if you were altering it in favour of a spouse, that would likely save inheritance tax. You can also do it so it might save inheritance tax in the future. So for example, if you have a grandparent who leaves assets in the will to the children, and the children are already grown up and they want the money to pass to their children, rather than making the gifts themselves, it might make more sense to use a deed of variation, so the gift comes from the grandparents. Otherwise, the parents of themselves got a 7-year clock, and if they don't survive 7 years, there could be more inheritance tax to pay. And there's other cases as well where deeds of variation can be helpful. So it is possible, it just depends on the circumstances.
I've got another if you are.
Yeah, we've got a couple of minutes left, so one more's fine.
I think you kind of covered this, but just in general, how early should you start inheritance tax planning?
As soon as you have an inheritance tax issue, I would say. It might be that there isn't anything suitable to be done right now because you might not be able to gift anything away. But in that case, if you know you have an inheritance tax liability on your estate, it might be that you can speak to a financial advisor, for example, about putting insurance in place to pay out in the event of your death to cover the inheritance tax liability. So it's never, I think it's probably never too early if you have an estate that's of a size that's going to be subject to inheritance tax. It's never too early to start thinking about how you're going to deal with that.
And final question, keeping a similar theme, how often should you review your tax inheritance plans? I think you did cover that.
Yeah, I mean, ideally yearly. That might be too often for some. So at least every couple of years. And certainly 5 years would be the maximum I'd want to go to, ideally more regularly than that. Yeah, and certainly if there's any big changes in circumstances, at that point everything should be reviewed too. If there's a client who owns a business and they sell the business, that should be a point in time in which the plan gets revised. If there's a death in the family, a birth in the family potentially, any other big changes like that, that's a trigger to re-look at the plan.
Okay, thank you. There's a few of us, but I'll email you about them because they're a bit longer.
Okay, fantastic. We will make sure for anybody whose questions we haven't covered, I will make sure that I come back to you either today or next week. So we'll make sure we send you an email. Right, well, thank you for joining us today. If you do want to have a look at any other examples of tax planning we've done, please have a look at our website. We have some case study pages there that we do update quite regularly. And if you have any questions about tax generally, please do get in touch. My email is Vicky, VIKKI, @pd-tax.co.uk. So thank you for joining us today.